everybody. Thanks so much for joining us. Welcome in. We're going to wait just a second to let everybody get settled in, and we see a few more logging on now. Welcome, Scotty, Ryan, Virginia, Ricardo, hey, Kurt, Henry. We can't see you guys, don't worry. Nobody panic. Awesome. Well, as more are coming in, we'll go ahead and kind of go over the beginning steps here. Jeff is still logging in, so we are waiting for him a little bit, but we're so grateful you could join us live today. Unfortunately, AC is unable to make it, so he won't be joining the call. We still have a really great presentation to look forward to as the markets have been really busy, so get ready for some exciting information. Next on our agenda, you may have seen our most recent email. We are starting a giveaway for our live listeners. We're so excited about it. At the end of the webinar, before questions, we will be providing you one of our lucky listeners with half off your next hard money processing fee. That's a $475 value. And I can tell you we've done this giveaway in the past, and we've actually had 2 people do their very first deal after receiving that giveaway, and they are rocking and rolling. So don't miss out if you do become our lucky winner today. If during the presentation you have any questions for Jeff or Wade, please enter them in the questions box. It should be on the right or left-hand side of your screen. We'll be sure to answer all of your questions at the end of the presentation. If your question is very specific to a deal that you're currently analyzing or looking at, we may direct you to one of our loan officers so that they can speak one-on-one, as they're all fully licensed and trusted advisors. So has Jeff logged on? Is he here yet, Wade?
I did see him. Yes, ma'am.
He popped in. Okay, so we will go ahead and move forward. So let's get started. Before, as always, this presentation is for general information only. By continuing to view, you agree and acknowledge that Catalyst Funding and/or its agents do not assume any liability or loss of damages caused by the information provided you today in this presentation. Whoa, that's a mouthful, right? You agree to conduct your own due diligence before moving forward with any deal. So this is our disclaimer. We get it out of the way in the beginning for those of you that are new. And I'll go ahead and welcome our speakers. I don't see Jeff yet. Is he not here still?
He popped in and then evidently popped out. I'm not sure. But
before you all,
we'll move forward.
Oh, here we go. Perfect timing. All right, so let's welcome our speakers. For those of you joining for the first time, I'd like to introduce you to our founder and CEO, Wade Comeaux. Wade is a wealth of knowledge, having started his career in 1995. He's worked for large national lenders and held positions such as executive vice president, leading sales teams of up to 14,000 employees at a time, 1,400. Wade is also an active investor and licensed real estate agent. He's passionate about helping other investors expand or start in real estate investment, which is one of the reasons that we host these webinars every month. Also joining us today, and a little tardy, Jeff, is our Director of Lending, Jeff Johnson. He has over 20 years of experience in lending and works closely with our sales and lending team to oversee all lending operations in-house, as well as assisting our clients meet or exceed their investment goals. So these two are our experts, and they are a wealth of knowledge. Be sure to use that questions box so that you are able to get everything answered today. And we'll go ahead and get started. Wade, I'll go ahead and pass the torch to you if you'd like to take this slide.
Sure. Yeah. Many of you know this, but we do want to cover the different offerings that we have. First of all, we're a one-stop shop for all of your hard money and permanent financing needs. We take great pride in the fact that really more often than not, you're going to be able to qualify for an incredibly wide berth of products with only one credit pull and one loan officer. We're real estate lenders built by real estate investors. So many of our team invest in real estate. Our team manager, Austin, is doing a deal right now with our company. And we are really focused on trying to take that knowledge that we've built and the mistakes we've made and help you avoid those type of mistakes over time. We've been involved in thousands of transactions over the years. We have 5-star average reviews on all social media platforms. We offer, as I mentioned, a wide berth of products, hard money, conventional, non-conventional loans as well. We have 30-year fixed income, fixed no income doc landlord loans. So if you're in a spot where you're self-employed or maybe you write off a lot of taxes, or maybe you're a full-time real estate investor, we do have products that can allow you to also add rental properties. We offer the full range of primary products as well. So if you want to refinance your primary to save money on your monthly payments, take advantage of these great interest rates, maybe purchase a new home to live in or a second home, or even to do a cash out loan. A lot of our borrowers have been doing cash out loans to take advantage of the massive equity that's been built up to fuel future real estate investments, right? There are a lot of great real estate mentors that say the worst thing you can have is debt equity in your home because it's really not doing anything for you to help you earn money or build wealth. Hard money interest rates start as low as 6.99% and 2 points. We have a really cool VIP flip program with rates as low as 9.9% and options as low as only 1 point potentially. And then 2 new products that we have. First, we're going to talk about this non-QM and blanket loans. So if you're a person who has a large portfolio, we have excellent pricing on blanket loans. You save a lot of money by putting all of the loans into one easy payment. It allows you to get far lower closing costs, and it can be a great option for people that have a portfolio that's greater than 5 units and 500,000. We also have that excellent non-QM pricing, that basically means non-qualified mortgage. So it's a loan product that allows you to invest in real estate, as we mentioned earlier, without having to prove your income. And then the latest thing that we have that we're going to talk a little bit about later on is a VRBO or an Airbnb product. We're super excited about that. So make sure that you stay on the call to hear about that product and the terms that come along with it.
Destiny, can you guys hear me?
Yes, we cannot,
Oh, hey, Jeff.
see you,
yes.
but I can hear you. There we go.
Well, there you are.
Wow. Okay. 20th time's the charm.
Oh, well,
Sorry, guys.
crossing our fingers.
All right.
Okay. Well, let's rock
My
and roll.
apologies. I think we're good now. Yeah.
That's okay. It was the extra entertainment. We should charge more for that.
Wait, we're charging for this? So, okay. I guess this is where we're going to pick up, right? So housing starts. This is a chart that shows basically new privately owned housing units started. And so if you look at this chart, you will see basically starting in 2010, you know, we've been slowly and steadily building units for quite some time. And there took a giant dip when COVID started and then a giant rebound trying to bring this back. And this, in my opinion, this is going to be the way that the rapid price acceleration we see is going to start to level off eventually, is when these housing starts turn into housing units that are built and finished. Texas A&M they have information that comes out once a month, and they just dropped it today, so we didn't have time to put it in the presentation. But one of the things I was able to read was about housing starts, and so housing, the actual building of homes is at a pretty good clip. But the leading indicator that measures, I think, permits and something else that kind of tells what houses will be built is at an all-time high. So I think the home builders are realizing there's money to be made there. Prices are going up, up, up. There's a huge demand for real estate and people want to buy houses. There's just not enough supply. So eventually I think it will catch up. And this is the chart that kind of shows that. And I think we've talked about it for a while, but just look at the last 10 years, right? These are not adjusted for anything. These are total units. And if you look at 2010 to 2020, that is the lowest level it's been at each decade, right? That is and we have more people now than we've ever had. So you combine the fact that over the last 10 years, we've built fewer houses than any other decade, I think since the 50s, but we have more people than we've ever had with low interest rates. I mean, it's a recipe for what we're seeing right now, which is a massive shortage of affordable new build homes and a real premium for homes that already exist.
Yes. Yeah, so whenever we hear people saying that they think a decrease in prices are imminent. At its core and at its simplest foundation, supply and demand drive price. And as you can see, there's a real lack of supply, and because of low interest rates and people wanting to, a lot of millennials wanting to buy. We covered that in several different recent webinars, and people wanting to move out of more condensed areas because of coronavirus into homes and have more space and have their own extra rooms because they may be working from home a portion or some of the time. They want to have their own pools, on their own amenities. So there's so many factors right now driving the price increases. While we do think that it's hard to envision a world in which we continue to increase 13% every year, there is definitely also it's a little bit difficult to see in the immediate term there being a big price reduction. So we encourage a lot of people, if you're out there waiting for a big price reduction, you may be waiting for some time. As people have also told us back in 2012, I missed the boat, I'm going to wait on the price reduction, and here we are, 2021, and they may still be waiting for that.
Yep.
The next slide is from Reuters, and it's interesting. A lot of economists polled by Reuters had forecast sales would decline in July.
Go back one. I think yes. Right. I have to go back one. Did we cover that previous slide?
I think this is the slide.
Yeah.
Okay.
Yeah.
And so Reuters had forecast that the sales would drop in July, and it did not exactly happen. They increased by 2%. So a lot of economists have been projecting this to a certain extent. I tend to think that some of them do not understand that supply and demand dynamic, but that is what took place in July. We did see that the median sales price increased year over year 17.8%. That's just a huge amount of increase. And we're going to notice in certain pockets within Texas and other parts of the country that sales are down. That does not necessarily mean that demand is down. There's just a lack of inventory, both on existing home sales and new home sales. And that is probably going to continue to cause upward pressure on price. And I don't see that there's enough new homes being built at the moment or in the foreseeable future to really change that significantly. But we are getting out of the hottest season of the year. As we go into the winter, it may be a more normalized winter season, which may just mean prices not appreciating as much as they have this last year and a half, and being more in line with what they've been in the past. Maybe a 6% type clip is where a lot of people really see it going.
Yeah, the other thing about the new builds is, while there may be a desire to build lower priced homes, with inflation the way it is, the materials to build cheaper homes are it's not possible in a lot of ways. Things are just so expensive, you can't price homes at that lower price point and make any money. So I don't expect any massive, really cheap houses coming on the market anytime soon. So these are a couple quotes that we grabbed that we thought were relevant. The first one is from Lawrence Yun, who is chief economist at NAR. Said, we see inventory beginning to tick up, which will lessen the intensity of multiple offers. Much of the home sales growth is still occurring in the upper end markets, while the mid to lower tier areas aren't seeing as much growth because there are still too few starter homes available. So that's kind of going back to what Wade was just talking about, where you're going to see in some of the tranches, you're going to see the lower tranches with numbers that aren't as impressive. And it's not that people won't buy homes, that there just aren't that many homes at that price level. Prices are rising so much. There's just not any activity at those lower buckets because there's nothing for sale in those lower buckets, very few things. People would love to buy cheap houses. They're just not available. Going forward, the market for existing homes will be, this is Nancy Van Den Houten, lead economist at Oxford in New York. Going forward, the market for existing homes will be supported by strong demand and mortgage rates that remain relatively low. However, inventory remains lean despite the increase in July, and that will keep a floor under home prices, which are unaffordable for many prospective buyers. So again, kind of what we're talking about, inventory is the big problem and why you're seeing such high increases in prices. And until that starts to hit, I don't think anything's going to change much anytime soon. Next slide.
This next slide is a new addition for us, but we thought it was very interesting, showing how much interest there is in properties and how competitive it is. So this is from Redfin, very recent article. 36% of pending sales under contract within 1 week, 50% under contract within 2 weeks. So, and how do we take this information and have actionable takeaways, right? So if you are flipping properties, this is one thing that we've been saying for some time. If you do not have a contract within a week or two, you are priced incorrectly. That's just the hard facts of it. And we see people sometimes that are newer, they get fixated on a certain return, or let's say that maybe the rehab went over budget by 15,000 and they want to make 50,000 on the flip. So they just get beholden and stuck on a price. And in this market, that is a mistake, because you should be selling homes incredibly quickly. Pricing properly up front is very important. You know, one of the things we always like to do is price the property in a way in which it will get multiple offers, and then often we can get well above that. Another pro tip that I really believe in is pricing your properties at the tranches where realtors will search. So I see people sometimes price at like 395,000. I think that's a mistake, because you do not get any of the people that may be searching 400 to 450 or 400 to 500. Like pricing is, it's not like you're at Walmart and it's going to be a big deal if you're priced at $3.99 instead of $4. You really want to price a way in which you have the most exposure to the most potential buyers, so you can try and get into that multiple offer situation. But you do need to be nimble. If you're not getting a lot of offers that first weekend it's on the market or within the first week, you need to really reevaluate your price so that you don't become stale. It's funny, in this market, if a home's been on the market for 30 or 45 days, buyers think there's something wrong, tremendously wrong, because it just doesn't happen.
Yeah, I mean, look at that second chart. If you, what is that, 2 weeks? Right, so basically half the homes are under contract within 2 weeks. And to Wade's point, if you get too aggressive and shoot for the moon, then all of a sudden, when you're bringing your price down, it doesn't look like, okay, well, I tried to get an obnoxious price and now I'm bringing it back down to the market. Now somebody thinks, well, what's wrong with this house? Things are flying off the shelves. I'm competing for this house or that house. Why is this house sat on the market for 3 weeks? So you put yourself at a severe disadvantage. Conversely, if you're a buyer, try to use that to your advantage, right? And I don't remember the stat, the number, but it was a pretty high number. It was basically the percentage of homes that were selling above ask was a really high number right now. So there's plenty of demand out there. Don't try to get cute with hitting a grand slam. Price it appropriately. You'll get plenty of offers. Hopefully you get yourself in a multiple offer situation. Next. So this is from the same article. It just kind of shows overall prices, right? So home sale prices up 17% from 2020. So if you look at the chart, each year you start in January, each year had a significantly higher starting point. And other than that little dip there in April and May of 2020, which was right in the peak of COVID season, it's just been a steady rise, right? I mean, that's a significant number over and above last year, 17% year over year. And I think I was looking at stats in Houston the other day, and I think over a 2-year period, if you had bought a house 2 years ago, the average price was up 25%. So these are, I don't want to say unprecedented, because I don't know if that's 100% true, but these are very interesting times. The prices that we're seeing are just going through the roof right now. And I think it's going to stay that way for a little while.
Yeah, I definitely agree. Before we move on, I did want to just mention the title of this article. It's interesting what they chose to focus on, but the title of the article was that 5% of home sellers dropped their price in recent weeks. And I think that's honestly the 5% of people who are probably trying to hit a home run. They're just going a little bit too far on that price by trying to stretch it to 550 whenever the right price was 525 or 500 or whatever the case may be. So I don't think that's an indication of a problem in the market because so many homes are under contract within 2 weeks. I think that's a larger indicator, and the fact that prices continue to go up so significantly.
Yeah, I don't know this to be facts, but I bet that number is not even statistically significant. That houses drop all the time is my guess.
I would think in other markets that number is probably significantly greater than 5%. Okay, let's go to this next one, and this is a very interesting topic. This is happening a significant amount in Austin, for sure. Dallas as well. There is some of this going on in Houston and San Antonio and other parts of the state. But if you guys haven't heard about ADUs yet, those are accessory dwelling units. And in housing markets where prices are going up rapidly and people have a difficulty buying the home as an owner occupant or seeing a way in which to make them profitable rentals, they are taking garages potentially, maybe adding additional unit onto the property separate from the original part of the property, or maybe just adding on to the existing property, but there is more value if it's separate and not connected in many examples. But these accessory dwelling units are a big trend right now, especially in California, New York, other places where home prices are even higher. But there were nearly 70,000 properties sold with ADUs in 2019. That's the latest year when keeping these statistics. And you see that the numbers were far lower back in 2000. So it's a very popular trend at the moment. If you're looking to get into either the VRBO space, this can be very attractive because you actually have two separate properties that can be rented at the same time. Or people are doing it as a long-term rental. They rent the primary and then rent a secondary. And then in addition to that, people are using it as a strategy to buy a little bit nicer home or in a more desirable neighborhood and use that additional rent in order to pay the mortgage. So it's a very interesting trend because in certain areas there were zoning requirements that were disallowing this in the not too distant past, but there's been a big push in a large majority of the country, especially these areas with higher home prices. Austin, it's a big trend right now, as I mentioned earlier, to allow people to take advantage of this opportunity. And I was actually working on a situation with my mom, trying to figure out a way in which to do that at my brother and sister-in-law's property. And it's a very attractive way in which to have a separate space. And in areas where it was completely disallowed not too long ago, it is now being allowed. There's a lot of pressure from municipalities to allow it. Next slide, please.
Yep. Okay, so this slide is something that's pretty topical. It is about inflation. So a couple of the bullet points there. This is the biggest inflation spike in decades. Consumer prices rose 5.4% in July from a year earlier. I believe that is the highest spike in 30 years. More prices, which exclude volatile food and energy costs, rose 3.5% in June from a year earlier. According to the Fed's preferred gauge, the Personal Consumption Expenditures Price Index, that was the highest rate in 30 years. This is crazy. Used car prices, as somebody who's trying to buy a used car for a teenager, used car prices in July have risen 42% over the previous years. And while inflation has surged in other countries, the increase in the US has been in part because of greater fiscal support. So, what this means to real estate investors is, in times of inflation, there's a lot of hedges against inflation, but one of them is real estate, in particular rental real estate, because not only are you buying a hard asset that over time should rise with inflation, same thing with rents. Rents typically rise with inflation as well. So if you can lock in a price now, even if you think the price is a little high and your monthly payment is high, well, just think about what the rents will be. 5, 10, the payment's not going to go up. I mean, your taxes might go up, sure, and your insurance, but the base mortgage payment is not going to go up, but rents should rise. So in theory, the cash flow on a property you buy should be the lowest it will ever be when you buy it, right? So as prices go up, as inflation happens, everything will go up except for that mortgage payment. That'll stay the same, not including your taxes and insurance. Plus, at the end of it, you have an asset that's been paid off, and it's worth a whole lot more money than what you bought for. Wade, were you gonna say something?
Yeah, I was just going to say, we're always trying to find what is the actionable takeaway from this data. Jeff did cover being in hard assets is a great opportunity. A couple other things to keep in mind. The way in which the Fed generally tries to control inflation is through, in large part, interest rates, right? So as interest rates risen, it puts a factor of your monthly payment on your mortgage going up as well, right? So that is a big factor. But then in addition to that, it impacts cash flow. So at the moment, there's a great opportunity to get in at incredibly historically low rates while still having an anticipation of price increases over time. The other thing to keep in mind with this is just the decrease in purchasing power, which means people over time have a little bit less to put into other areas for investment. So I do think that you're going to see the people who have put their money towards this at the moment, right? Really getting involved in real estate investing at this moment while you have more purchasing power, while you have more opportunities to invest, can make a big difference. Because if your cars are costing more, gas is costing more, all of your other things, you're going to have a little bit less money potentially saved. So it's very important that you get into hard assets where you can counteract that. And as inflation grows, we're going to anticipate that rents grow, whereas your income may not grow at the same level. There's another article in the journal yesterday talking about how unless you're in a government job or other jobs where there's a guaranteed increase for inflation, it's tougher on people who are outside of that, right? That aren't getting a guaranteed increase because they're not one of those government type jobs. So there could be impacts to people's money to spend and invest. So you want to be diversifying, not just depending on your hourly job or your regular employment job, to have more income coming in that increases as inflation increases at a more consistent level. This next slide, we've had this for a while, but it is important to understand what is going on in the market. So there's a change much earlier this year in March where Fannie Freddie decided that they were going to make a change to limit the amount of properties or loans, that could be delivered to Fannie Freddie in certain categories. And in an effort, I think, to push homeownership, which is a very, very admirable thing to push without question, they had decreased the number of rental properties or second homes that can be delivered to Fannie Freddie. So the previous limit was 17%. It was dropped to 7%, and then further with Fannie down to 3% in June, which is a very, very low number, historically low, never been that low. And it has impacted a lot of things on conforming loans. What's really been good about it, though, is that we've seen private money, which means like Wall Street investors or large institutions, insurance companies, moving into the market with a lot of really cool, interesting products that are not beholden to a lot of the rules that we've seen in the past, but also very, very attractively priced. So the reason we're talking about this now is that there's been a real concerted effort to have those people move into the space with exciting products. We were actually at multiple events earlier this year where we were told by multiple hedge funds, some of the largest hedge funds in the country, that the most desirable asset is single family real estate for them, right? So I think if you're in the space, that's very important, but also understanding that both in loans and direct investment, these people are going to be trying to bring new and innovative products. So staying a part of this webinar and constantly reading up to see what new exciting things for these ADUs or for VRBOs, the products that are coming out that allow you to invest in more flexible ways, are something that you always want to educate yourself on.
So the good news about this situation, and what gives me confidence that the private money or the Wall Street money will pick up the slack, is they looked at servicing and who was paying, and counter to what you would instinctively think, the non-owner occupied space actually performed better than owner occupied. So if you were around at the time of the mortgage meltdown, that was not the case. And I think the biggest reason was it was, if you had a pulse, you could get a mortgage. So there were tons of people buying rental properties or second homes or whatever the case may be in very low credit quality, not a lot. Like I said, just about anybody could get a loan back then. So naturally, when things go poorly, the first thing to go is going to be the rental property. Now, and what's been, the change is rental property loans are more difficult to get, right? It's not just anybody can get a rental property loan. Now, it's not crazy tough or anything like that, but there are standards, and most folks that take the step to buy rental properties are financially responsible, and they are able to be disciplined and manage their finances, as opposed to everybody wants an owner occupied, everybody wants a mortgage, which is understandable, but it's a I guess a lower quality of borrower typically, and that's why you're seeing the rental properties perform. So all of that is to say, I think despite what the government does, I think that private money will step in and fill that void and be here for a little while.
Next slide.
So this is, we always put this on here just as a point of reference. Rates right now, I don't know if they're at an all-time low, but they certainly look that way on this chart. 3.125 was that's the owner-occupied rate. So whenever you're looking at non-owner occupied rates, it's going to be a little higher than that. But like Wade said a couple of slides ago, rates are ridiculously low right now, and as inflation becomes more and more of a problem, eventually the normal way to deal with that is to increase interest rates, and that will happen. So get it while the getting's good, I guess. Tons of people are still refinancing. I don't remember the stat, but a lot of people refinanced over the last 12 to 24 months, but there's still a lot of folks that have not, and now is a great time to do so, or just get into these rental properties at such a low interest rate. Make sure it's fixed, that you're going to be set for a low payment for quite some time. Next slide.
Yeah, so this is the data from Houston. The first bullet point, single family home sales ended a 13-month positive run with a 6.1% decline. I think it's very important to understand that this is not an indicator that prices are coming down. This is just the total number of sales. And this is really an inventory driven reduction. Prices are still going up significantly. Days on market are still very low, but we are seeing, there's only so many people who have an existing property who are willing to sell. We're moving through a large portion of that. So what's going to fill the void? Hopefully new construction eventually. And then maybe some people deciding to continue to sell their properties, but there's only so many existing properties that are going to be able to be sold over time. So I do think the total number of units sold, we're going to see downward pressure on that. That's going forward, especially as we move into the winter. I don't know that the prices, unless a lot more inventory comes on market, is going to be a big difference. Days on market still way down from prior year, 56 to 26, that second bullet point. We've talked about this in the past. A normalized market is 6 months of inventory. We're at 1.8 months in Houston, down from 2.9 a year earlier. And 2.9 is still a very healthy turnover in a market. It's literally half of what is considered equilibrium, but we're still well below that. And for much of last year, the national average was below where we were at in Houston. But right now, Houston 1.8 and national average 2.6. So that is a big gap in between the national average and Houston. And then that's really common across Texas, because I think a lot of the tax, state income tax, and then just the overall economy of Texas is really causing a lot of people to move in, very few people to move out. So that's a real positive as well. On a year-to-date basis, single-family homes sales are running 19.1% ahead of 2020's record pace. So just a huge increase over last year. And then if you look at a couple of these other important factors here, on the bottom right, single-family home rentals fell 20.1% with the average rent up 11.4. So that's the same factor here. Low inventory, prices are going up, but not as many new sales, because I think if you think about it from a tenant's perspective, with prices increasing, are you really going to leave your existing property to go somewhere else and pay more money? Or are you going to try and maybe have a nominal increase to your rents with your existing landlord? So I think we're going to see that same component happening in the single family rental space as well.
Yeah, the thing that I look at to kind of, can you go back for a sec, please? The thing that I look at to kind of look at what's going to happen next month is you look at the single family pending sales. They're pretty flat, right? So I would suspect that August's numbers will be pretty similar to August 2020 with regards to the volume. The number of units, I'm sorry, not the volume. The number of units will be roughly the same as my guess in August. I think the volume will be probably 10% higher, roughly, because that's what we're seeing. Price increases, and I think it says 11% here because there were fewer units. But if you flatten that out, I think you're going to see a lot more volume for sure.
And I don't know why. I think we should look at it real quick before we move on. The rents this month, record 2162. February 2020, pre-COVID, about $400 less than where we are today. So that's a huge increase post-COVID, right? So if you had a property and you were cash flowing, $300 a month at 1768, now you're up $350. That's a really big and healthy increase to your cash flow, potentially doubling it in that time frame. So that's the power of real estate in an inflationary environment, right?
That's the inflation. Yep, that's the inflation we're talking about. Rent's going up. Your payment's not going up. I mean, maybe a little bit because of taxes and insurance, but not that much. Not the level. Not $400 in a year and a half. That's for sure.
Right. Also, we are hiring in all markets. So if you or know anyone, as a reminder, we are definitely hiring in San Antonio, Austin, Dallas, and in the greater Houston area for salespeople and operational people. So,
yeah, if you are, I guess at the end of the call, we'll put a little email on there to where they want to, if you're interested, to reach out. So San Antonio, excuse me, pretty similar story, right? The actual sales were down a little bit, 9%. However, the price was way up, 18% year over year, which I think was higher than Houston. The average price a year ago was a shade under 300. Now it's over 350. I mean, that is a huge increase in San Antonio. Anecdotally, we talked to one of the groups we work with that has property that does deals in Austin and in Houston and San Antonio, and they tell me they do about just as many deals in San Antonio as they do in Houston. So a lot of real estate investment action going on in San Antonio. Median price, 298. Median price a year ago, 258. So not quite as big a jump as far as the average goes, but still pretty significant, 15% over a year ago. Days on market, again, down from 58 to 25. So 25 average days on market, but more than a 50% drop from last year. Pending sales, 3240. As far as the rent goes, let's see, so there were roughly 1,400 rentals this month. There were 1,600 last year. So that is a 13% drop. However, like we said, the price has gone up almost 10% in a year's time. Last year, rental property was going to net you almost 1,600. Now it's over 1,700 for the same, presumably same units. Price per square foot, like you said below, an increase of 9%. And then the days on markets for the rentals, they're down 33%. So rentals are not only giving you more money, they are sitting on the market significantly less time. So all good things for landlords, right? If you held out last year because you thought that was too expensive, well, that's kind of what we talk about. There's never a good time to try and time the market. If you're disciplined with your approach, you buy good deals at the time. On the long run, you're always going to come out ahead.
That's one of the great things about purchasing properties that are in distress is that you build immediate equity. So even if you didn't time the market properly, it would just eat up some of your equity, but not necessarily put you in a situation where you were upside down. Conversely, stock market, There is no immediate equity capture. So it's really just based on the price at which people are willing to pay in the market. So you can have a real loss if the price were to go down in an immediate term, right? It's paper loss until you sell it, but you are actually upside down at the moment if that were to happen. Okay, so Dallas. Dallas is a very interesting market, very strong flip market at the moment. A little bit more challenging, I think, at times to find rental properties there from the people that we work with. Oftentimes they do spend some time investing in Houston or San Antonio, although there are opportunities there. There's a relatively robust 2 to 4 unit opportunity there. Just so everyone is aware, you can buy 2 to 4 unit properties underneath normal conforming loan products, which is a very exciting opportunity because you get that best possible pricing. And in addition to that, with our blanket loan products, even above 2 to 4, you can include, as long as you're doing a large portion of single families, we can include 20 unit or 30 unit properties into a refinance as well. So that's a pretty exciting option on those blanket loans. But covering Dallas specifically, you can see very comparable to Houston and San Antonio in that the market prices are up significantly, 15.7% over last year. Active listings way down 30%. That's also a common trend. Days on market significantly lower than last year, 27 days less than July 2020. Closed sales, they also had a downtick, not unlike Houston there, but the months of inventory still significantly lower than last year. So you also see that price distribution that we were talking about earlier, and the common thread that there are fewer affordable homes, right? You can just see in that very few of the homes are below 200,000 in that market, and a significantly greater portion are above 200,000 in a market where, you know, it can be a little bit difficult for first-time home buyers to get in at that price point. Although, whenever we look at the affordability index later on, exponentially more homes at that price point than the markets from where people are moving with greater regularity, like California and the East Coast, because home prices are even far higher than that there.
Yeah, I just noticed the closed sales. If you look at this number compared to the other 3 markets, this is encompassing a massive area, because I think Houston's closed sales were 10,000, San Antonio were 4, Austin will come up on is roughly 4. This is almost 40. So this is encompassing the entire North Texas region.
Yeah,
a lot of houses up there. And I also noticed that all of the days on market, if you look at each market, Houston, San Antonio, and Dallas were all right around 25. However, if we look at the next slide, Austin, 12 days on market. So despite the significant price increases that they're seeing in the Austin market, there still is not nearly enough inventory. The average days on market is 12, which is half of the other major metros. It's just bonkers. The median sales price is $480, so almost $500,000 for the median price, which is not the average. I don't know if the average is listed on here, but I gotta believe it's well over $500,000. If the median is 480, so that's up 37% in 1 year. We're talking about Houston, which is experiencing quite the renaissance, is up 25% in 2 years. Austin is up 37% in 1. Closed sales, 4,000 units. So, and it's down 10%. So kind of like we were talking about, it's finally catching up to what's happening last year, and the squeeze on inventory is keeping those numbers flat or a little bit down as far as volume, or I'm sorry, as far as units goes. Total listings, 5,100 up, so that's good. However, the active listings are down 36%. So again, that is a measure of how fast deals are being sold and how few market houses are coming on the market. 3,900 pending sales, that is down 11%. So I would expect the units for next month to probably follow that number and be down a little bit. Let's see. Total volume, sales dollar volume, 2.4 billion. That is up 20%. And then months of inventory, it is less than 1 month. which is quite impressive. So more of the same. We've been talking about Austin for a year now. It's more of the same.
Yeah, and it's just important to know your market. Like, are there buy and hold opportunities in Austin? Yes, there are. They're predominantly in that 2 to 4 unit space. Can be difficult unless you're in one of the surrounding areas to find a single family rental there. But talk about a hot flip market. I mean, incredibly hot. It's arguably one of the hottest markets in the entire country because of all the tech companies moving in and just an enormous amount of job opportunities. Real wage growth is growing significantly there. Whenever we look at the next slide, the affordability index slide, you can see that. If you look at, we'll go to the next slide, please. Thank you. And if you look at this slide here, what this really shows is the areas of the country that are considered least affordable, and it starts from top to bottom, right? And of course, the major metros across the country are always the least affordable. But what's interesting is that, for example, Dallas and Austin and Houston, Dallas and Houston in particular, depending on your measurement, probably top 6, top 5 largest cities in the US, but they are not in the top 5 as far as lack of affordability, right? They're significantly more affordable than the other areas that are considered to be highly desirable because of job opportunities, amenities, access. So you look at these numbers, and it's interesting. Like Austin, the income, household income is $71,000 on average, right? And then you have New York and Los Angeles both significantly below that. Miami and Newark even lower. And then the home prices in New York and Los Angeles, just a shocking number compared to Austin. Like, it almost sounds crazy how high Austin's prices are compared to Dallas and Houston, but they're almost half of what they are in those other areas where the average income is far less. So
yeah, I didn't even realize, if you look at Austin, the average household income is, other than San Francisco or Plano, which I guess is a pretty small sample size, it's the highest. It's in Virginia Beach. It's the highest on there. Like, it is. People are making a lot of money in Austin.
yes, I mean, they've really had a lot of great those tech jobs. And that's, if you look at San Francisco, that's a highly tech-driven market as well. So the tech jobs definitely pay very well. But the reason that we cover this really is we talk about what's actionable. As a real estate investor, what can I take from this, right? And I think a big thing is that people are still going to gravitate from areas where housing is less affordable to areas where it is more affordable. There's been an enormous move over the last 20 years. It's been significantly greater than the pace before, since COVID has hit. And that is one of the biggest reasons. Even if the US economy struggles a bit, or other things happen on a national level or even an international level, what you're still going to have is people wanting to move to areas where their cost of living is more reasonable, right? If you still have comparable amenities, you still have comparable job opportunities, maybe even better job opportunities in comparison to some of these environments, like Miami as an example, but the housing is significantly more affordable. We're going to see upward pressure on home prices, right? Upward pressure on rents. So that's one of the reasons that we're big believers, and a lot of our clients are as well. A lot of the mentors across the country really encourage investing in Texas, and particularly if you're looking at single family long-term investing, Houston and San Antonio. In fact, we work with some hedge funds. One hedge fund in particular, their documents state that they can only invest in Houston, and they're a San Francisco-based hedge fund, but they raised a significant amount of capital with the express purpose of investing in Houston. So, and that's not the only company doing that. We've seen these build-to-rent projects. There was a builder, I think it was, can't remember if it was Pulte Homes or something like that, that built an entire community with the objective of selling it to owner occupants, and they sold it to a hedge fund, and that profit was 50% higher than anticipated by selling to someone who wanted to rent out the entire community. So definitely a very attractive single family buy and hold environment.
Yeah.
I think that is the last slide before we go into a product that we wanted to cover. Jeff, do you want to take that one?
Sure. So, Destiny, I see by your presence, we're getting near the end. So we do have a new product. for folks out there that are, I saw an article talking about how Airbnbs and VRBOs, a lot of people are starting to buy these properties and supplement their income. I mean, I talk to people anecdotally about how much money they're making on these deals, and it's literally, I don't believe them. They tell me how much money they're making. So in some instances, if you get the right property, it is a great investment. But we do have a product for those of you that want to get into this business. There are no income docs and no DSCR ratios. So for you folks that are doing loans that are non-conventional, you'll know that a DSCR is basically showing that you have to have a property that cash flows. There is no income docs, no DSCR requirement. You need a 700 FICO, and we will do up to 70% loan to value. Pricing starts at 4.25. These are 30-year fixed rates, and you do not need to escrow. You can if you want, but you don't have to. And we've spoke to a lot of folks around the country in the business, and whenever we mention this product, they are surprised because nobody has a product, as far as I can tell, that has these features. So if you have been listening to these webinars or doing your own research and you want to get into this business, give us a call, and one of our loan officers are more than happy to talk to you about our hard money and our new Airbnb product.
Yeah, and I do want to emphasize a few things here. So whenever you see 700 FICO and 70% LTV, those two numbers do not sound enormously attractive. And candidly, we have other products that if you're fully documented are entirely different, right? If you qualify, you can buy a VRBO or an Airbnb with a conventional loan without question, as long as you qualify to make up the shortfall that you may be having because your mortgage may be higher. If you're buying an $800,000 home or $1 million home in Galveston or something of that sort, you're not going to be able to get a lease or show what's called an appraised rent rate on a normal lease that will cover that monthly payment on $1 million home. It's just not really feasible. But you may be affluent enough, or you have enough income coming in, either from other rental properties or your primary job, to where you can cover that. So you can get the best possible rates, right? And it's higher than 70% LTV. You might be able to go 80, maybe even 85 if you chose, but you pay PMI. Don't know that I recommend that, but you are talking about a much less out-of-pocket situation at 85. But that is the ideal situation if you can do it. But a lot of people can't do that. They don't make so much money that they can take on into their debt to income ratio a huge payment like that and still qualify for that loan. So what's great about this, and we just don't, to Jeff's point, see this out there very often. We've scoured the earth and gone to multiple events to try and find ways in which we could have access to this type of product. And it's very, very rare. The majority of people either have a fully documented situation for a non-owner occupied loan, or they have that debt service coverage ratio where you have to have the comps in the area saying the rents are strong enough to cover that payment for you, right? Because they're not checking out your personal income. So while the 70% and 700 FICO do not sound extremely attractive for a product where you have neither of those things, you don't have to prove your income and you don't have to prove that it is a cash flowing property. Those are very, very attractive terms, because more often than not, people just don't have this available to them. So if you're a full-time investor, if you're a full-time flipper, if you're self-employed and you don't have enough income to get documented for a conventional loan, or if you qualify for conventional loans, you just can't buy $1 million house because it's such a big payment, this is an ideal product if you have the cash to put into it. And we are seeing, to Jeff's point, he was saying sometimes he doesn't believe it. We heard of one person in San Antonio on a home that they would have cash flowed maybe $300 or $400 on a traditional rental. She had been making $7,000 a month on that property, which sounds preposterous, but it happens to be close to Fiesta, Texas. So there are some other things, but we hear people doing it in Galveston and even near the medical center. Like if you're getting a property that has some draw, either medical facilities or sporting events or beaches or hiking, like they are pulling in enormous numbers on those properties.
Yeah, I would, for you folks that are in Houston, I love my city, but you would be surprised at how many people come here as a destination. Mm-hmm. I was talking to one of our coworkers who he has a a side business, and he was telling me, he's like, you don't realize how many people come to Houston to do whatever, right? It's like a destination. So that obviously works for the Airbnb crowd as well. So it is eye-opening and is a great way to make money in this space.
Outstanding. So I know we need some time for questions, right, Destiny?
Yeah, we have a few. Excuse me, I've lost my voice. So two things I want to cover really quick. So we did answer, David and I answered the questions in here, but I think there are questions that everybody could benefit from and that others may have had. And again, if you or you know anyone that is interested in working with us or becoming a part of our team, then please feel free to shoot us an email at info@catalystfdg.com. We also have jobs, plural, at catalystfdg.com. I should write that on here now that we're going to be advertising that as part of our presentation. But please send your resume in, and we'll be happy to reach out and set up an appointment with one of the managers for the area that you're, or the department you're trying to become a part of the team on. The other part that I would like to get into, oh, you're welcome, Erica. She said thanks. Great webinar. Is our, before anybody signs off, I know if you don't want to hang on for questions, that's fine. But before everybody logs off, we have our winner for the first giveaway that we're doing in here, and that's half off your hard money processing fee. That's a $475 value. And our winner is Erica Meitz, M-E-I-T-Z. I'm sorry, Erica. My pronunciation of others' names is not the best. But we have your email, so we'll go ahead and send something over to you, letting you know what the time frame is and any other terms and conditions that go with that. But congratulations, and thank you everybody for joining us live today. You will receive a recorded copy of this webinar emailed to you tomorrow. So without further ado, let's jump into some questions. The first question is, what is an ADU? Does this mean someone rents part of your house while you live in the main part?
So actually, it is an accessory dwelling unit, and it is separate from the primary property. So it's not renting out a room as much as it's renting out a separate area. Some people use their garages. In fact, that particular article that we were referencing from the Wall Street Journal was talking about people converting their garages for this specific space. But by design, as I understand it, it is to have an entirely separate area that is blocked off by a wall or a lock that is only accessible from one side. So you do have more privacy with this alternative. And a significant number of people are actually not just converting the garage, but building an additional dwelling on the property that is separate, like a mother-in-law suite would have been in the past, but people are using that as a rental income opportunity.
Awesome, thank you. All right, so our next question is, please explain what is meant by the inventory, months of inventory. Does this mean inventory is 1.8 months, then the supply of houses is expended in 1.8 months? So I think they're just trying to get a better understanding of what that means.
Right, sure. So months of inventory were, if every property that is currently listed for sale, how long would it take at the current rate, how long would it take for those properties to sell? So if there's a lot of properties for sale and they're not selling at a very fast clip, then you will have a very high month of inventory. If there are fewer properties to sell and or they are selling rapidly, you'll have a low month of inventory. So it's basically a measure of, at the current buy rate and the current number of properties for sale, how long would it take to sell everything? 6 months is considered like the market in balance. So if you see one at 6 months, that's in balance when times are tough. Sometimes if it's above 6, that means that it is a buyer's market. And if it's below 6, it is a seller's market. And when it is 0.8, it is awesome.
The way that I always think about it too is if no more houses were put on the market for sale, then they'd all be sold in that time frame. So that 1.8. That's
that's
I think
exactly
that's
correct.
Quick little rule of thumb. So when you see those low numbers, it's like, oh no, it's hot. It's hot out here. All right. So this next question I'm in the Houston market and I have seen buy and hold opportunities. Can we expect some fix and flips in the future? And then they go on to add, I'm referencing deals Catalyst offers to their investors.
What did they say? I didn't understand the last sentence.
Oh, so I think they're asking kind of a two-part question, but they're mostly referencing deals that we're providing. So they asked, they said, I'm in the Houston market and I've seen buy and hold opportunities. Can we expect some fix and flips in the future? And then they go on to add, I'm referencing deals Catalyst provides to their investors. So I think they're asking, can we expect some more fix and flips in the Houston market? And also, are we sharing fix and flip deals?
Okay, that's a great question. We do not see as many fix and flip deals come across. We have not seen as many recently. We've been putting out more buy and hold opportunities, honestly, but we are focusing on that area and trying to get more of those opportunities for our investors. We have seen a relatively large uptick in our overall loans in the fix and flip space. So while we have not necessarily sent out as many of those deals to our buyers list within Catalyst funding, we have seen a big uptick in those overall loans. So we think we're seeing a market that is definitely more balanced with a mix between fix and flip and buy and hold. And we actually have quite a few properties on the market right now. If you are very interested in them, I would strongly encourage you to reach out directly to Zach Gable, who is leading that charge, and he can set you up to either attend one of our lunch and learns where you find out how our process works on acquiring those properties, or just have a good in-depth conversation where you can find out what your goals are, where you want to invest, what your targets are, et cetera. You're looking for flips or buy and holds, and then we can kind of tailor our outreach to you to let you know whenever we have a deal that really fits your needs.
Well, and we did have that one that you and I were talking about this morning, the case study. And so originally we had a deal that we sent out, and the investor that picked it up intended to do a buy and hold. That's their primary strategy. And while they were in the midst of the rehab, they got an offer higher than they thought the ARV was going to come in. They purchased at 180 and they got an offer for 300. So they chose to flip it, and it ended up being a great deal for them. They only had 14K out of pocket. So there are some hidden gems. And again, while that wasn't what we thought the deal would be, and it wasn't what the investor thought the deal would be, it worked out that way. So it was a good deal all around. So definitely stay tuned for those. And if you are interested in linking up with Zach, I don't have his email up here, but you can reach us at info and we'll all see it. I'll make sure that he gets in contact with you. But our lunch and learns are quite fun. So don't want to miss out on those.
Yeah.
All right. Well, that's it for questions today. If you guys have any more, be sure to shoot us an email. Again, you'll get a recorded copy of this webinar. Be sure to like, follow, and subscribe on our socials so you can get some of this content before we share it on our monthly market update. And thanks for joining, guys.
Thanks, everybody.
Thank you.